All right, we're live and we are with the commodity report today, and we got a special guest, Josh Young, today. Really excited for this conversation. Just want to lay out like a general thesis on what we are all thinking about the macro landscape as it comes as we're looking at energy, oil, gasoline, and so on. So let's see where we're all thinking here, and then we'll go from there. But I'm really going to let Kevin and Josh kind of run the show today because this is super interesting. But to get you guys started out, big picture view, let's talk about oil. What are you guys thinking about the oil markets? Do you guys think it's something that's bearish, bullish? What are you guys thinking about the oil markets today?
Josh, I'll kick it off to you. Love to get your thoughts, and then I can follow up.
Sure. So I noticed this morning almost every major investment bank has now gone bearish on oil. And most of the banks don't have prop trading so much anymore. I think, I'm trying to remember which rule it was, but one of the rules after the financial crisis, they got sort of forced out of that over a few years. But it used to be amazing. You'd look at how the analysts would do, especially the macro sort of commodity analyst calls would do, versus how the prop trading would do. And then these days you can look at like Vidal and Trafigura and so on, and how they do versus how these bank calls do. And magically, the investment banks are these amazing contrarian indicators. They're wrong like 80% of the time. And yet these trading houses make money every year. And the investment banks used to make money every year trading oil and other commodities. So, when they're all on one side of the boat, it feels really comfortable being on the other side. So I actually feel even more comfortable being bullish here than I was prior to seeing this sort of almost conformity, unanimity that oil must go down and, revise lower price targets by basically everyone on the street in the last couple of weeks.
Yeah, I would say, the number one, and nothing against them, but like Goldman Sachs is kind of the first ones to usually, either be the one to be the indicator for the top and the indicator for the bottom. And that's what I've seen over the last couple of years. So, so you're asking about the price action. All right. So price action is definitely bearish right now. I don't think we can deny that, but we are entering some areas of potential support when you're looking at crude oil, right? And that's sitting at around the $68 level, $68.50. And what you want to really see is some buyers actually stepping in and then also catching these shorts off guard. I know that we'll talk about the commitment of traders report, but we have seen an increase in managed money flows on the short side here that I think is actually kind of putting in some pressure. And maybe just trading off of the technicals, that downtrend that we've been seeing here. What I actually am interested in over the next couple of weeks, if not months here, is the narrative really kind of playing out. What I find very interesting here is either the major agencies, if you're even looking at the EIA, OPEC, what have you, IEA, either they're incorrect when it comes to some of their reporting, which that can be the case, or we have a bigger problem down the road here when it comes to the macroeconomic landscape, not only just here in the United States, but also just maybe some of the weakness in China that might be creating these differences. And the reason why I say that, and I always try to break it down really simply, right? You have what you're producing as an oil company, right? You have what you can actually put throughput within the refiners. And then obviously you have energy demand or gasoline demand just in general. And you really haven't seen a significant drop off when it comes to gasoline demand that's being reported right now, but you're seeing the price action reflecting that maybe demand is waning. Now, are we maybe seeing the unwinding of some of that geopolitical premium? Yeah, maybe. But in my opinion, there was only about maybe $1, maybe $1.50 in that premium trade when you're looking at the Israel-Iran situation and what's actually happening in the Middle East, because, when you're looking at the oil infrastructure, for the most part, it's been protected. I feel like there is a disconnect somewhere. It's either we do have a slowing and it just has not been reflected in the numbers when it comes to demand, or we have a significant amount of short selling that's taking place by managed money, which, if you guys follow us in the past, we kind of say, usually managed money is wrong over the longer term. And when they do get it wrong, it actually can have a really nice little short squeeze. I just don't know where we're at. Now, I'm also concerned about the 200-week moving average. That's one I look at a lot. And we've been under that moving average for a considerable amount of time when you're looking at when you're looking at crude just in general, and then also when you're looking at like heating oil, it's been under that moving average for several weeks, actually almost about a month now, if I'm not mistaken, a month and a half, almost 2 months now. So all of that for me, when you're kind of looking at that 200-week moving average, the failure to reclaim that and push higher, and if you kind of overlay that with equities, just in general, the S&P 500, or even if you're looking at macroeconomic data like GDP, usually that is actually a leading indicator that we have broader economic weakness. But once again, the data right now just does not align up. So I feel like somebody's offsides here, and maybe Josh can provide a little bit of color there. I know you and I, we have discussions going back and forth regarding the EIA data, and I think you know, when it comes to the revisions and things of that nature. But I just feel like there's a disconnect, and if you're kind of looking at that risk reward ratio to the upside versus downside risk, you kind of look at it and say, okay, if we have a broader economic slowdown and we do have a pullback in the S&P. This is going to be either your first indicator, or if we're not going to have an economic slowdown, crude oil in general and the energy products, maybe outside of heating oil, are completely oversold right now, and a solid balance can take place. Josh, what are your thoughts around those thoughts here?
Yeah, I try to stay fundamentals oriented, because I found that both technical as well as positioning, it's fun to talk about. And positioning, I think sometimes is helpful for sort of shorter term bounces or explaining sort of shorter term movements. But I found that eventually the price follows the fundamentals over, let's say, the medium to longer term. And so for my business, which is finding underpriced equities that have catalysts to revalue them, it's more relevant for me. You know, the short term, it'd be great if I could understand it reliably, but sort of the longer term matters a lot more for the multi-year sort of price movement that I'm looking for in the equities. So from a fundamental perspective, like you were saying, Kevin, it's really this remarkable situation where prices moving down, but the fundamentals are looking better, not worse. And at the same time as the price is moving down, the narrative is getting worse, right? You have these banks downgrading oil and lowering their price targets. You have these news articles about things that sound scary for oil, but then you look at the actual data they're pointing to and the actual claims, and for the most part, they're not that bearish for today's market. And you know, I really like following Jeff Curry, and he makes this good point repeatedly. He was talking about this, I think, a couple of years ago when people were really worried about a recession, that oil prices based on today's market, not based on what might happen in the future, because oil futures clear on a monthly basis. There's actually a physical clearing of some of these contracts. And so I think it's going to be really interesting to see the disconnect between the current physical market and the sentiment and people trying to trade these sorts of potential moves in the economy through futures. And I think there's room for there to be this really big sort of reset in those future expectations based on the current market. So I think we're going to see sort of a test of that theory, and at least sort of intuitively, theoretically, it sounds very compelling to me. So I think over the next couple of months, we're going to see, and then you can look at some of the satellite data and look at some of the revisions on the weeklies and so on, and things look pretty good. And I guess the two other things, and I think we'll get into more of this. One, I think the narrative around OPEC and some of this other stuff has gotten very, very negative as prices have moved down, where their actual activity has gotten very positive. And then again, from an inventories perspective and also from a drilling activity perspective, things just keep getting better for oil, not worse. And it sounds so weird as to say that as prices are falling, but you can look at demand, Kevin, like you were saying, and look at supply, like I'm talking about, and look at trajectory in terms of drilling activity, wells coming online. Even like the most avowed oil bears, they claim that activity is flat, but then they show numbers showing that wells coming online in the US for shale, which is sort of the marginal supply for oil, are down significantly in the last couple of months. And if that trajectory continues, you'll have even fewer wells come on, which should challenge supply even more. So again, it's sort of one of the biggest disconnects I can remember in investing in oil and gas for the last roughly 2 decades. So it's pretty amazing to me. And it's going to be one of those questions, I think, where, hey, is the truth in this 200-day moving average that you're talking about, is the truth in the technicals, or is the truth in the data and the drilling activity and the fundamental demand and that trajectory.
So you brought up a really good point there, Jason. I sent you a chart. If we could cue that up. I know I'm always late. So you brought up a really good point when it comes to the, like, once again, so gasoline demand is actually higher this year than it was in 2023, right? And at this point in time, we were trading at what, $86 and some change this time last year. Might be off about we were trading at around $93, right? So you have higher demand, and then when you're looking at the inventories themselves, especially when you're looking at U.S. inventories and compare them to a 5-year moving average, I mean, we're still on a relatively low basis taking place here, and global inventories has not risen as aggressively. But when you're talking about these energy companies, and what I want to kind of get to is this crack spread. So we have the 3-2-1 crack spread, high level, take 3 barrels of crude, making 2 barrels of gasoline, 1 barrel of diesel, heating oil, whatever, right? And there's several different crack. There's like 20 of them you can see on the CME website, right? So we won't get in all of those intricacies, but we're trading right now at around $15.21 for that crack spread. And Josh, I mean, it's the lowest level that I see. Actually, we actually cleared another hurdle, but I believe it's the lowest level we've seen in like 3 years. Going on 4 years. Actually, the last time we saw these levels were February 2021. When you're looking at these energy companies and you're trying to evaluate this, knowing the landscape that we're in right now, is this ultimately bearish or bullish when it comes to energy companies or even just the energy markets? Because that spread kind of signifies that margins, especially when you're looking at the refiners, might be getting squeezed here a little bit. And you can make a case that maybe a lot of these companies, like the major integrateds, like the Exxons, the Chevrons, that have seen passive flows coming in because globally, the S&P 500, risk off sentiment, we tend to see flows going into utilities and energy companies. But right now is a massive divergence between the two. So what are your thoughts when it comes to the crack spread, the collapse of the crack spread? I'll even call it a collapse because it's actually dropped significantly since the highs. The highs this year, we were sitting at around $32. We're half that right now, more than half that.
Yeah, I think it's great that you brought this up. This is one of those sort of very interesting stories. So let's start on the oil price implications of this and sort of the narrative versus reality, and then let's get to the energy stocks. At least, again, from my perspective, is purely my analysis and opinion, and people shouldn't rely on this and figure out sort of their own approach for investing and take their own risk and consult their own advisors. But the way I see this is that refining margins had been and are intermittently good signals for the oil price and for oil market either weakness or tightness. And so historically, there have been times where refining margins have fallen, and that's a signal that demand is very weak, and therefore oil prices are going to stay low or go lower. So that's been sort of a heuristic. It's been a signal people have used. And I've noticed the macro oil analysts that are most focused on refining and have backgrounds in evaluating the refining companies or have just come out of that sort of space are the most bearish that I've seen, or sort of especially the ones that are not sort of perma bearish, are the most bearish oil here and have been sort of the most bearish for a little while. But it's sort of a weird thing when you think about it. If you step away from oil just for a second and just think about what it means for one part of a value chain of anything to be oversupplied, and for the price of that thing in a value chain to fall, it doesn't necessarily mean that the demand for the overall thing is necessarily bad, and it doesn't necessarily mean the price for the overall thing necessarily needs to go down. So one sort of analogy, and it's imperfect, but I think it's worth considering, is imagine if there were two new steering wheel manufacturers, two new steering wheel factories that were opened up by existing steering wheel manufacturers. Let's say there's 10 suppliers to the global auto market for steering wheels, and you add, let's say, two new factories, and you add, let's say, 5% capacity to steering wheels, but existing auto trends stay where they are. So if you increase supply by 5% of steering wheels, but let's say auto demand only increases by 1%. So the price for steering wheels is going to collapse. And if you were evaluating the auto market based on steering wheel pricing, you would say, oh my God, there is Carmageddon right now, right? Cars are going to, demand is collapsing because steering wheel prices have collapsed. But this is clearly an analytical error because the price of steering wheels has collapsed because there are too many new steering wheel factories. And again, I know this is an oil discussion, so let's bring it back to oil. So it's not that there's necessarily too much or too little oil. It's that this part of the value chain, refining, has seen substantial capacity additions over the last few years. And it's actually hard to tell exactly how many new refineries there are because there's all these teapot refineries in China, and there's sort of intermittent utilization of this new large refinery in Nigeria. I always mispronounce it, Dangote or Dangote. I forget sort of the right pronunciation. I think there's like an English one and then a Nigerian one. It might be slightly different. So I apologize if I mispronounce that, but that's roughly 1 million barrels a day. And it could actually, I think, be a little more or a little less. And then there were all these issues with refineries during COVID and then restarting after COVID, where utilization was artificially low because there was lots of capital expenditures and repairs that were deferred, and then there were explosions and fires, and so utilization was artificially low. So suffice it to say, I think that crack spreads are best understood in the context of a steering wheel supply glut rather than an auto supply glut as the analogy. And I think it's a analytical error to rely on them too heavily for an indicator of crude market demand or lack thereof. And I think the thing to really worry about would be if prices fell so low that refiners were forced out of running, if their margins went negative, which they're not. And certain refineries might be slightly negative, but most of them are not. So again, from an oil market perspective, that's how I see this. And I guess I'm curious about your take before we get to the energy equities in terms of the crack spreads.
Yeah, no, I'm right there with you. Yeah, and we definitely should have provided a little bit of disclaimer before. Usually, like when I talk about energy markets, right, we're talking about a week, 2 weeks, maybe even a month out, right? And you have a longer term view. So sometimes we could disagree on some of the minutia, but I think the end goal is still the same when it comes to the majority of the views. I'm right there with you, right? If you're going to bring on more refining capacity, you're just bringing in more supply. And we've had a healthy amount of supply activity, not only when you're looking at extraction, but when you're looking at throughput from these refiners. And that might have a little bit of a downward impact when it comes to the finished goods. What I, once again, usually I'm like super confident in my convictions here, and I'm just a little bit puzzled because once again we have just this breakdown in price compared to what the fundamentals are kind of showing, and obviously you're kind of talking about also on the international scale. I think one thing too, the market may have gotten a little bit ahead of itself, and I know I'm one of them as far as the China reopening story, right? Like we just have not seen that boon as aggressively as I think the market was expecting, and I think the market was also expecting, and I was not on this one, was expecting a huge draw from China on the international scale when it comes to global inventories. And that's just like, that's not the case. China actually has a pretty robust refining network within its own country. And they actually did build up their stockpiles, post-COVID, and even kind of actually like lingering after COVID. So you didn't have to have that much of a draw. And then they have, new supplies or getting more supplies from countries like Russia and things of that nature. But once again, I'm at a little bit of a crossroads here. Like either the market's going to rip hard and rip face, right? We're going to have this huge short covering event, or we have a bigger problem within the U.S. economy at least, and or on the global scale. Let me go and ask you two things. So I want to make sure I hit both of these. So when you focus on companies, there's extraction, right? There's upstream, midstream, downstream for those that really don't know. And maybe you can kind of provide some color on this, but the upstream kind of being the extractors, the midstream being those refiners, those that process, and you have downstream, right? Getting to retail or the finished user. And one of the things that I've seen here, especially on a day like today, we have gasoline trading at $1.90, give or take, when you're looking at gasoline futures. Now, gasoline futures are not going to be a one-to-one to what we see on the retail side. But are you kind of looking at the downstream players and saying, hey, maybe there's an opportunity there? Because when you're looking at the AAA national average for gas, and there's probably better data sets, but this is probably one that a lot of people do watch. Gasoline prices this time last year were the same, even though prices have pretty much collapsed when it comes to gasoline. Do you find like there might be a fundamental value area when it comes to downstream players because of those, because of this disconnect, or maybe is there an arbitrage there, or do you think those are, two mutually exclusive things that are kind of going on within this space? Because it looks like it for me that downstream players, just knowing the input costs have gone down significantly. At the tail end of the summer season, seems like somebody is making a decent margin on here, and it doesn't look like it's the refiners. Maybe it's the downstream players. What are your thoughts?
Yeah, so I think normally when people talk about this, they include both the refiners and the gas station owners in that sort of downstream, and then midstream is sort of more, I think, the pipeline sort of companies. So I think the refiners, you're seeing their profits getting squeezed in that crack spread that we just looked at. So, and again, and that's just the 3-2-1 is just one of many potential crack spreads, depending on the specifics of the refiner as well as the specifics of their crude input. This is sort of more of an average and just a sort of high level heuristic rather than the exact numbers. I did see that gas station margins were temporarily higher, but gas stations are sort of tough businesses, and they're sort of more. As I understand it, most of the time they make very little money on their gasoline, and make their money on selling cigarettes and alcohol and convenience store items. And the best performing gas stations that I've seen have been the ones that have been able to sort of transfer sort of more into like a 7-Eleven style, or in some cases there's one that's sort of like well known. I forgot the food item or something, but there's
Casey's, the pizza. Casey's.
Yeah, there's food items that bring in people to individual specific branded gas stations and stuff, which is amazing. But that takes you really far away from, I think, the oil world, and is a very difficult thing for me to evaluate. And then also valuation wise, those gas stations, especially because of this transition and because of the sort of value added on the branding side, the valuations on those have been pretty high. And then, Buffett went and bought one of the truck stock companies a few years ago, and I think that sort of I think I'm remembering 15 times earnings. It might have been a little higher, a little lower, but it was a pretty high valuation, and people were surprised because they thought that meant that I think people were worried that trucking would sort of go away and that demand for diesel would go away, and therefore people would pay very low prices for these things. And I think that's the opportunity Berkshire saw. I'm trying to remember, it might have been Travel Centers, or it might have, I don't remember the name of the particular company that that Berkshire bought. But so I think there's that opportunity maybe for the gas stations, but again, for them, it's more about, I think, this sort of transition to being branded convenience stores and other, sort of fast food restaurant sort of things. So I think that's a tough place for me to have a real view on. I will say sort of on China as well as on US demand, there are sort of two specifics that are not economically driven that are worth noting that I think are messing up the demand data. So in the US, there were enormous uneconomic subsidies to turn cooking oil, and in some cases, pre-use cooking oil. So basically taking food away from the restaurants and ahead of being used and sending it right to biodiesel. And so biodiesel demand has been really high because the processing of it has been heavily subsidized. And then I think there have been some heavily subsidized sales as well, or incentives to either buy it or for the gas stations to sell it. And then in China, there's been a shift towards using natural gas powered trucks, which ironically gets back to that Buffett bet. Hey, what happens if that happens here? We'll see, but it hasn't happened yet so much. It was sort of T. Boone Pickens and Aubrey McClendon. They had this view, like this vision sort of 20 years ago, and that didn't play out, but it is playing out right now in China. And so you have these sort of two distortions where demand has actually been pretty good, except that in China, they've ramped to some extent the truck demand for natural gas, which has eaten into demand for diesel in China. And then in the US, there's been this substitution of biodiesel. And again, it's not perfect, right? Because that still takes away from the demand for oil. But if you look at it as sort of all uses of energy, and then sort of how much of the market's really going to get cannibalized by that, sort of how realistic is the growth that you've seen in liquefied natural gas powered trucks in China, or how much more growth are we going to see in biodiesel? I think both of them are constrained by various factors. I think we've sort of seen, it looks like, famous last words, but we've seen what looks like the bulk of that sort of consumption shift. And so when you look at the holistic picture, it looks great. And then when you net out those two specific things, you, I think, understand some of that temporary weakness. And then when you look at the ordering trends for trucks, for diesel powered trucks, as well as the actual movement away from biodiesel from some of these biodiesel refiners, where you've seen in a couple of cases, they're actually shifting, having done the conversions to biodiesel. There are a couple of them, it looks like, I think I saw announcements where they're actually shifting back to regular diesel refining. And then there's a number of projects that were either in the works or planned that are getting mothballed or, delayed on that biodiesel front. And so I think we've sort of seen the bulk of both of those. And then that sort of gets you more comfortable, I think, in terms of what's the supply demand picture and where is it going. I think it's a lot less bad. And I think the sort of risk in straight lining these sort of demand, or even expecting an acceleration of demand destruction or substitution in China from these liquefied natural gas powered trucks, and then in the US from biodiesel. In the US, especially, the biodiesel replacement, that you can sort of see, it's actually the pendulum swung too far and it's actually shifting back. So I think it's helpful to sort of look at the specifics of these markets and better understand where that demand is gone and if it's coming back or not.
Yeah, we're seeing a lot of shifts, right? It seems like over the last 4 years, you could even say last 8 years, we've had a huge shift when we started with solar and wind, and we're going to get broader energy, right? Solar and wind. Now it's kind of maybe relying a little bit more on the natural gas front. The scaling up of LNG refiners, and I'll ask you about that too. The LNG regasification and expansion of that infrastructure seems like that's going to be a little bit more of a longer term vision here for the United States, maybe. What is your? I had something else. You brought up Berkshire. Let me bring this up real quick, and then I want to ask you about LNG. Berkshire is trading at 52. Is Warren done? Is Berkshire done trying to pick up Oxy right now? Or you think this is once again just kind of an overdone level? And you can maybe give us some insights into your thoughts about the fundamentals around Oxy in general.
So there are a number of different perspectives on Berkshire buying Oxy in the first place. I happen to actually have been at that Berkshire meeting where they first talked about their Oxy position. I almost fell out of my chair when I heard about to talk about it, because I'd done a lot of work on it and I didn't own the stock and I don't own the stock, but I look at it really closely and I know a number of people that work there or worked there. I'd seen different transactions that they had done and sort of gotten to know, I think, some of their strategic positioning and sort of what was going on that was working and not versus sort of what the narrative was. And so my read on it was just that Oxy was it was sort of the most levered oil producer bet that Berkshire could make in 2022 when oil prices were ripping after Russia invaded Ukraine. And the timing of their purchases, I think from memory, they only started buying after oil prices ripped, but then pulled back a little. I think they started buying in either March or April of 2022, but there were sort of two oil price spikes in 2022. And I think they bought after that first one started to fall off and after Oxy stock has started to fall. After that sort of initial spike after Russia invaded Ukraine. So my take on it, based on looking at almost every investment Berkshire and Buffett personally and Munger personally pre-Berkshire had made in oil and gas equities and on the private side, that this was purely a levered bet. They talk about liking the management team, but the management team leaves a lot to be desired. They came extremely close to going bankrupt during COVID, which is amazing because of the strong balance sheet the company had prior to the current CEO coming in. So she led the sort of damage to their balance sheet. And the buck stops with her. And so I think it makes sense in evaluating the company as well as management, sort of what changes she made to the company. So anyway, levered bet on oil, arguably low quality management. Berkshire Buffett did the best he could to sort of like make it sound good. But the reality is that he lent the company a bunch of money and made a ton of money on it. And before he started buying the stock, he was actually a seller of the stock at a fifth of the price in the market when he got common shares paid as a dividend in kind rather than getting paid cash by Oxy. So it's not so surprising to me that oil prices would fall and Berkshire would eventually stop buying Oxy, which is consistent with my view that it's sort of this levered bet on oil. It doesn't mean that they won't come back in and buy more of it. It's just that when you look at the valuation for Oxy, and again, people should sort of come up with their own views on this and make their own investments. This is just my personal opinion, and you shouldn't rely on it. But when I look at Oxy and I look at sort of the comp sheets and look at the analysis that people do on it and how they rationalize Buffett's investment in it, it doesn't look that cheap. And a lot of the arguments like the extracting CO2 out of the air unconnected to power plants or anything, just doing the extraction purely, just having a facility out in the middle of nowhere that extracts CO2. These are things that are not economic. Yeah, there's subsidies for them, but they make no sense engineering wise. It is exciting as an energy investor where it's sort of a perpetual motion machine. If you can burn natural gas to go extract CO2 using one of these direct air extractors of CO2, I mean, you're going to need an infinite amount of energy because you can barely extract enough CO2 to offset the energy produced to do the extraction. So that sort of business to me seems very low quality and very dependent on government involvement. So that's what I think about it. I think it makes sense. Buffett hasn't been buying it here. I wouldn't be surprised if he starts to buy it, but I also wouldn't be surprised if he starts to buy it a lot lower than where it's trading, given sort of the history of the business, the history of his investment in it, and the long history of Buffett and now deceased Munger's investments in oil and gas companies over the last, 50, 60 plus years.
So let me follow up because you focus on a lot of the shale plays, obviously, right? And that's been a huge, news driver over the last couple of years. Obviously, United States, what's being reported is that we are the number one producer in oil right now. And that's also being attributed to the expansion of shale in some respects. Now, let me ask you the first question. Do you think we might be seeing some signs of peak production when it comes to shale? I think I've seen maybe a post from you around that. I wanted to kind of get your thoughts.
Yeah. So first of all, I have a mea culpa. Like, I've been wrong on what would happen with shale for a lot of the last couple of years based on what I saw happening versus what happened subsequent to what I saw or sort of changes. So just to be clear, I thought that shale was peaking a couple of years ago, and I was wrong, and shale production is up since then. And it's important, I think, when you get something wrong to identify it, acknowledge it, figure out where you got it wrong, and then have a lot lower level of confidence, but also be able to sort of recalibrate. So what I think is happening right now is not that shale is peaking forever. And you see some of these sorts of claims from folks that were also wrong 2 years ago and 5 years ago and 7 years ago. And again, I think it's important to recalibrate. So there have been a couple of changes that drove that incorrect call. So one is these horseshoe wells. So basically, instead of just drilling a well, you drill down and then horizontally in shale and then complete the well with a multi-stage fracture stimulation of the rock. Instead of just drilling down and then horizontally, there's a new technology or a new sort of technique that's being used where people drill down, drill horizontally, and then are able to turn around underground and drill back the same way. So you can get twice the length on the same sort of amount of lease acreage that you have the rights to. And so that's dramatically cut drilling costs and increase the amount of tier one acreage that's available. Because if you're going to have, let's say, a $70 break even on a 1 mile lateral, if you can make it a 2 mile lateral and cut 30% off your cost per foot of shale, horizontal that you're exposed to, you now have maybe a $50 break even. And so as that technique has sort of gotten rolled out and better accepted, and now there's a couple of years of production history, that's sort of shown that there's sort of more inventory. And then the one other thing that we've seen is companies have sacrificed their remaining inventory in exchange for better production. So not just doing these horseshoe wells, but also if they could put, let's say, 8 wells per square mile, and in different zones and be able to get again, break evens at, let's say, $70 oil. Again, just using the oil price as sort of the variant, and the natural gas and natural gas liquids as sort of stay flat just for the purpose of this. If they go from 8 wells to 4 wells on that land, their break even might go from 70 also to 50 or 45 or 55, somewhere in that range. And in many of the zones and many of the remaining locations in the Permian, it's not a question of what's the rate of return. It's what's the rate of return subject to how many wells are drilled on the land. And so both of those, when you better understand those trade-offs, I think it really helps explain sort of what happened, which is companies took their inventory and said, hey, instead of having 20 years of stay flat inventory at $70 oil, I'll have 7 years of stay flat inventory at $50 oil. And by the way, I'll go and focus only drilling on that. I'll spend the same amount of money I was planning on spending, and I'll actually grow a little instead of staying flat because these wells are so much better. So that's what's been happening. So eventually you'll end up running out of these best locations, and maybe the technology will get better and the techniques will get better, or maybe you'll just be out and you'll see production collapse. And you've seen that in many fields, and eventually that'll happen in the Permian. But I think there's still another leg up of production growth. I just think you need a lot more rigs. I think you're sort of burning through this set of technology improvements and drilling technique improvements, as well as, through the upspacing, drilling fewer wells per section. You're burning through that really fast, and there isn't an obvious next offset for that. And so I think you're going to need much higher prices, which is where I'm bullish sort of medium to longer term, because I think the world needs this particular oil incremental source. And you're going to need much higher prices to induce the next set of rigs, which are going to go drill worse wells that need a higher price just to break even. And you're going to need these companies that look amazing because they're drilling half as many wells and producing just as much or more. You're going to need them to agree to essentially look less amazing by going and drilling worse wells at a higher break even with less productivity. And so I think that requires much higher prices. So anyway, that's the shale dynamic as I see it. I know I sort of rambled there a little, but I think that's sort of it's important to sort of see where the narrative went wrong and what's happening now. And again, that's not the consensus at all. And that's part of what's so exciting to me about these investment banks going bearish oil here, is that I think they're making this analytical mistake of thinking that, hey, if you add a bunch of rigs, which many of them have these forecasts for rig additions in the next 12 months, that you're going to get the same drilling efficiency. And there's almost no one in the industry that thinks that, but almost all the investment bank thinks that. And I think I'm going to go with the industry guys over and my own analysis of this situation over the investment bank. It's almost like they're sort of straight line extrapolating rather than understanding the nuance of how we got here to be able to better understand where we go from here.
So let's talk about the Permian once more here. So let's set the stage. 2 weeks ago, Reuters had a report. It was on August 29th, if I'm not mistaken. They had a report that 6 members or 6 delegates or what have you, some of their sources, 6 sources were looking at OPEC plus basically resuming production or trying to increase production levels, potentially starting in October. And then we had another report last week kind of undercut that narrative or stating that there's now an agreement to really kind of pause on those production increases, at least for the next 2 months or so, as prices try to rebound or at least catch their footing here. Obviously, there's a lot of politics that go into that. So one thing to just kind of note, if you're a viewer, when you get these reports, take them with a grain of salt. People are going to trade on them, but as we get closer and closer to the official meeting, which is going to be the first week of October, I think it's like October 2nd or something like that, you'll probably continue to see this back and forth. There's a lot that's going on within OPEC plus, especially the smaller countries that want to start ramping up production because it's hurting their GDP not to do so. And then you have the bigger countries, the bigger influencers like Russia or even Saudi Arabia, Kuwait, what have you, that kind of want to stabilize production right now. The reason why I bring this up, I want to get your thoughts on that story and the turnaround there, and that being one of the major catalysts, and one of the catalysts maybe for this downside price action move. And 2, Do you get concerned that we might have a 2013, 2014 type of moment where OPEC and OPEC Plus basically say, okay, we're done with the Shale expansion story, and we need to start trying to potentially flood the market and try to collapse margins again and try to reclaim some market share? Do you think that that's something that could be possible out there? Is that in your view? Yeah, I'm not saying happening tomorrow, but do you think that that narrative starts to creep into their thoughts over the next year or 2 years because of the rapid expansion that we are seeing with shale and the improving technology that's made it a lot more efficient over the last couple of years?
These are great questions. So I think the right background for understanding any news report about OPEC is that there was a falling out between OPEC Plus somehow and some of these major news organizations. So there's some personal animosity between the OPEC members, like both the countries, I guess officially, oddly, but really like the energy ministers of these countries and their OPEC representatives, and specific reporters at specific major news organizations, to the degree that OPEC, I think it was a couple of years ago, officially uninvited a set of reporters to their meetings. And again, they're televised, they're, whatever, streamed. So it's not like they're really missing out too much, but they're not able to go ask questions, which is considered important. But I think it's really important to understand that context, as well as a history of very spotty reporting where, there were sensational articles and news reports about OPEC in the last few years that were at least partially untrue, and that, I think were sort of odd to observers, where it was sort of curious how it made it through editorial review, some of these news stories, given just how vehemently they were opposed. And then when more color came out, it turned out to be sort of a very, very misleading headline or story or so on. And it's one of those things where the OPEC uninvited these folks, and then they just kept doing more of these sorts of stories. And so, for example, there were stories about OPEC dissent and how there were OPEC members that were really unhappy with each other, and how supposedly, like you were saying, OPEC was falling apart like 2013 and 2014.
That happens every 3 years, it seems like, right? That seems like that story comes up.
No, it comes up every 6 months or so. And this particular one, it appears in retrospect, was driven by Angola leaving OPEC. But Angola left OPEC, as far as I can tell, because they were so totally embarrassed by missing their quotas. People talk about OPEC cheating in terms of countries, producing more than their quota. Angola had really big problems, reservoir-wise, and governance of the companies wise, and governance of the country. Like, they had real challenges, and they missed their quota every year for a bunch of years. And eventually, OPEC was going to reset their quota down, and Angola had plans, as they always do. We're going to grow. It's sort of like some of these countries, they have these big plans, and then every year they announce the plan, and every year they miss. They have these like porcupine charts, they call them, where it's like always supposed to grow, and then you reset down, and you're supposed to go and reset down every year. So
it's airline companies, they do that all the time.
So, a number of these news stories, they were claiming this sort of OPEC dissent and, OPEC is falling apart, when in reality, what they were actually capturing were these couple of countries, Angola included, that just couldn't meet their quotas, and they were very mad. And so they were saying things to reporters or whatever. But again, it just shouldn't have made it through editorial review, or the stories should have been massively toned down by their editors, and they weren't. And so, it made things really complicated if you're just trying to figure out what's going to happen, because you have this sort of weird stories from large news organizations that are generally very reliable. And then, weird stuff from OPEC, where they also have had stuff that's they had over 2 million barrel a day demand estimate for this year. Honestly, I went into the year thinking, hey, IEA is usually wrong, OPEC's usually right. And OPEC must have some orders or something from China or somewhere else to have this sort of high demand estimate. And lo and behold, they haven't, at least so far. It's been more than half the year, and they've been very wrong. And, I was wrong to think that OPEC would be right. I don't really understand how it's possible for them to have been this wrong, because they do get advance orders for their oil ahead of sort of these disclosures, and they do set their sales prices. These various OPEC plus countries, especially the largest ones, do get to set their sort of prices famously, Aramco does this with their, they'll have a different price for each different market that they set every month or quarter. And so it's very weird that they were this wrong, but they I think also sort of had these credibility issues. And I've written about them having issues with their claims on spare capacity. Matt Simmons, I have his book up on the wall. Like, he pointed out the just absolute ridiculousness of their reserves claims, where you had they would basically keep their reserves static as they would produce their oil, but oil is a depleting resource. So if you don't have new discoveries to point to, you probably don't have as many reserves today as you did a year ago, right? You need a technology improvement or a discovery to add reserves. You don't just magically add reserves as you deplete them. Either you understated the reserves before, or you're overstating them by not writing them down. So there's a very basic, famous credibility issue for OPEC. So that's the context for it. And I think it's important because it answers the second question, which is, look, I think OPEC knows they have a credibility issue. I think they're trying to navigate a very challenging thing, which is, being a cartel without sort of the threat of a real threat of physical violence between most of the members, means that it's a very, there's always this tension. You're always going to have a small amount of cheating. And given that, I think they've actually navigated things extremely well, minus the Saudi lollipop cut. Saudi cut an extra 1 million barrels a day and created all kinds of problems for themselves last year. That was dumb and predictably dumb. And it seems like they almost sort of like made it up on the spot based on what happened to oil like the day before, the oil price the day before or something. So that was a poor decision. But again, generally, they've navigated these things well. I don't think they're signaling that they're going to have a price war. If anything, it looks like they're signaling a potentially historic amount of cohesion. And I think that these news reports are just irritating them more, which actually increases the odds of cohesion. Because let's say you're UAE or Iraq or Kazakhstan or one of these other countries that has some oil spare capacity that's proven that they could deliver into the market. You get these Western reporters in France or Houston or wherever talking about how you're terrible and you cheat all the time and you're not trustworthy. It's not so crazy to think that, hey, you want to sort of behave for economic and non-economic reasons to rebuild your credibility. And the data is showing that there's sort of more cohesion now than you've seen in a long time. And then there's one other data point that I think you'll find interesting. I wrote about this a few years ago and people thought it was ridiculous. And then it actually sort of has been a pretty good indicator. If you look at the tanker rates ahead of OPEC meetings, one of the tells in 2014 is the Saudis went and bought absolutely crazy amounts of tanker supply. Essentially, they got the contractual rights ahead of flooding the market in 2014. And I didn't know enough. I lost tons of money on that. So again, it's very, very tough to make these calls. And the reality is all of us make these calls wrong a lot. And it's just important to start with, hey, there's a good chance I'm going to be wrong about this. What can I do to improve my odds? So you look back, like I did with the shale stuff, and just try to figure out, hey, what else have I gotten wrong? And what more can I look for? So if you look also in 2020, tanker rates went a little crazy, which it was odd that happened because demand was falling because of COVID shutdowns and so on. So right now, tanker rates are not going crazy, even with the Red Sea essentially mostly shut down with the Houthi attacks. So in the context of that, tanker rates are relatively low. And I think that should give people a lot of comfort. If you ignore everything else and you look at, hey, what are they saying? What's Reuters and Wall Street Journal, whatever else saying, Bloomberg, and then what are tanker rates doing? I think that should be pretty helpful in terms of figuring out what OPEC might do.
I gotta respect. I have a lot of respect for individuals that come out and they talk about their wins and the reasoning for their wins, and then also talk about where they made mistakes. And you also have to give credit to people that actually have a conviction and have the data to support their thesis, right? I mean, the thesis can be wrong. If you have the data to kind of support it, then obviously you get a little bit more of a leg up than some others that come out, and maybe some of those investment banks that we kind of talked about earlier that just kind of follow price and just throw a number out there without any real meaningful data or information to be able to back that up. So I got to give you mad respect for that. I know a lot of the viewers do too. This will be the last question that I have, and then I'll kick it to Jason. I don't know if he has any questions here. Over the next 10 years, 15 years, and this is going to be a specific question, what are you more bullish on? LNG, not companies. I'm not talking about the energy companies, not LNG companies, but are you more bullish on liquefied natural gas and its application or crude oil on a global scale? What do you think?
From a volume perspective, I think liquefied natural gas will certainly grow volumes much more than oil. I think there's almost no question there. I think that's the consensus view. And it's just a question of, hey, will demand for LNG grow by 5 times the rate that oil demand grows, or 2 times the rate, or 10 times the rate? But the global demand for liquefied natural gas is voracious, as evidenced by demand growth despite much higher prices today than you saw pre-COVID. So prices are very robust for liquefied natural gas, and demand is very robust despite substantially increased supply. So I think that tells you that that seems very likely to continue. The other question I think that's sort of embedded in that is price. And I'm way more bullish on the price for oil than the price for liquefied natural gas, for a variety of reasons. I think it's much easier to produce natural gas. There's much more identified natural gas in places where you can produce it, such as Appalachia here in the US, and West Texas and Southeast New Mexico, and then up in Alberta and British Columbia. There's just enormous amounts of gas, and there's increased takeaway capacity. There's these LNG terminals that are getting built, and there's more getting planned. And there was a permit moratorium for a year or so in the US here. It looked like sort of politically motivated, sort of complicated, almost like a third rail type topic. But that seems to be ending right now, and maybe is subject to an election outcome. But it does seem like the longer term trend is way higher supplies for liquefied natural gas, lots of available supply that breaks even at, let's say, and meets sort of capital cost requirements at, let's say, $3.50 or so an MCF from a supply perspective here, which would translate to a global price of, let's say, $7 or $8 an MCF, which is far lower. I guess actually it's getting closer to the oil prices. Oil prices fall, but I think that's sort of a reasonable price to underwrite longer term, plus maybe a couple dollars for profits across that value chain for LNG versus oil, where there's much less supply available. The marginal cost of that supply is way higher, and it's just less clear who's going to do it. It's less clear where it comes from. And so even though there's less demand growth, I think the supply challenges for oil may substantially overwhelm that lower demand growth and lead to much higher prices from here.
I appreciate that, Jason. I'll kick it to you. I've been hogging the mic, man.
No, that was great. That was the point of the discussion today. Have a high level breakdown between both of you guys, because everybody hears my opinions all the time, but I want to hear your guys' opinions, and especially going through and hearing what Josh does, kind of his framework and understanding. This has been awesome. So I just want to thank both of you guys for doing this. Josh, thanks for joining us. This was a lot of fun getting to hear you talk, getting to listen to you. And I'm sure the audience enjoyed it. We had a big audience today. We didn't have any questions because that was kind of a very high level breakdown. And that's what happens sometimes is you answer so many things that there's just not really much to be said. And I think that was one of those. It was well explained. I think everybody has a good view of what we're thinking in the energy market today. I also love the one point you brought up earlier, which was oil trades. You said your buddy said this. Oil trades at the current market, while the stock market kind of trades forward looking. And I think that's incredibly important, because when you're looking at the market, and if I'm looking at oil and I'm looking at, let's say oil's breaking down here, let's say oil just continues to break down here over and over and over again, there's probably something really like the market's probably going to follow it at some point. And the other way, when oil starts to bottom and starts to trend up, the market usually follows it at some point, especially stocks, obviously, the energy stocks, but even the broad market at a certain point. So it's kind of a very interesting that was said earlier. So just want to thank you guys so much, expanding my mind as well as our audience. And thank you guys for joining us, and we'll see you guys soon. Please hit the notification bells on YouTube so you guys see when we're going live. And please follow the speakers. Please follow Josh. Please follow Kevin. These are great guys, obviously great follows. So we'll talk to you soon.